Okay, I'm going to drop some numbers on you, then I'm going to tell you what's interesting in this piece that I'm scrolling through right now. OpenAI, they raised 40 billion, yet they're burning through 14 billion annually. Nvidia hit record highs on their market valuation, but there's a lot of volatility. And Microsoft admitted recently what nobody wants to say out loud, and it's that their AI business is generating 13 billion in revenue, but they're spending 80 billion on infrastructure. So let's talk a little bit about the cash burn that no one's discussing, specifically the OpenAI cash burn. So according to this beautiful piece by Where's Your Red, it's Edward Zitron. Essentially what's happening is OpenAI is on track to lose 14 billion in 2025, and they're projecting a revenue of 12.7 billion. So essentially, if you're looking at unit economics, to make it simple, they're spending $2.25 to make every dollar of revenue. Now, here's where it gets pretty interesting. OpenAI, they expect to burn 320 billion between 2025 and 2030. The company plans to spend 40 billion per year starting in 2028 just on training new models. I was reading the other day that that's more than NASA's entire annual budget just to train AI. And that 40 billion that they just raised recently, half of it is contingent on converting to a for-profit by end 2025, which isn't happening. Now, if Elon's lawsuit blocks that conversion, then they only got 20 billion. And then SoftBank is literally borrowing 10 billion just to participate, and their credit rating might just get downgraded just for that investment. So the valuation math is, should we call it delusional? It's 300 billion valuation on 4 billion revenue. That's 75 times revenue. For context, that's a bigger multiple than Tesla at its absolute peak, right? When it was worth more than every other car company combined. So I thought that was just pretty interesting. And that's why a lot of headlines are talking about the AI bubble and it bursting, et cetera, et cetera. But I've got some good news at the end, right? Or some positive news at the end. Microsoft in their Q1, it's over here. I think it was the earnings report. So what's interesting with this piece is it kind of reveals the truth. Their AI business hit 13 billion in annual revenue, but they're committing 80 billion to AI infrastructure this year alone. So that's spending $6 for every $1 of AI revenue. The economics, the unit economics, they're broken at almost every level. OpenAI's new O3 reasoning model, I think it costs 30,000 per complex task approximately, and their deep research product loses money on every $200 per month subscriber. So we're essentially subsidizing everything. All these models, all these prompts that we're running, they're essentially completely subsidized at the moment. And training costs are exploding, running costs are potentially unsustainable. Here's what nobody's saying. It's all subsidized, right? It's what I was mentioning a few seconds ago. So what do we mean when we say that it's all subsidized? This piece I thought was really interesting by Startup Spellis. So here's an example. If you're looking at like Cursor, for example, the AI coding tool, they charge $20 a month. And the industry analysis, it suggests that for every $20 you pay Cursor, roughly 10 to 12 goes to API costs from OpenAI or Anthropic. Those AI companies, they're paying Microsoft or Google for compute at discounted rates. And those cloud providers, they're buying billions in GPUs from NVIDIA. So I explained kind of the part of the supply chain, essentially. It's subsidy economics at this point, all the way down. And it's kind of creepy. Cursor negotiates volume discounts from AI providers. OpenAI discounted Microsoft Azure credits from Microsoft. Everyone's betting on scale to eventually make the math work. Real house of cards. But here's the problem. The new Ultra plans from Cursor and others that are charging $200 a month, they're not really that new anymore, but for just 20x the usage of the $20 plan, that's 10x the price for 20x the usage. So the real economics, they're starting to sort of show through. So what do I want to say next, right? I want to talk about this McKinsey piece that I keep bringing up in my videos. Their January 2025 super agency report revealed a pretty shocking disconnect. 47% of employees believe AI will replace 30% of their work within a year, but only 13% are actually using AI for even 30%. It was 30% of their daily tasks. And leaders think it's just 4%. Then you've got the BCG piece, which I tend to bring up quite a bit as well, closing the AI impact gap. Even more revealing, 75% of all executives rank AI as top 3 priority, but only 25% were reporting meaningful value from their AI initiatives. And that kind of makes sense because we have inflated expectations on the short term, but our expectations are kind of too low on the long term. We have an urgency bias and short-termism. Now, the thing is that the companies are spending billions on AI. They're not actually using it at this point. And I think it's called classic bubble behavior. Now, what's interesting is some of the smartest people in the safe seem to be repositioning themselves. I think we all remember when Ilya, another of OpenAI's co-founder, left it to start an AI safety company. He raised $1 billion immediately. Some of the insiders are hedging their bets. I think we also saw that Microsoft was embracing DeepSeek on Azure, despite it threatening their OpenAI investment. They're playing both sides because they know the current path is just freaking unsustainable. I think this was one of the most telling pieces that I actually read. And the talent's flowing to infrastructure, pick and shovel plays. When the gold miners become shovel sellers, the gold rush is really ending. I read that on X the other day. And here's some other sort of warning signs. The promises keep getting pushed back. So you got the Future of Jobs report. I think it's a beautiful report. You should read it sort of yearly. And then, so the WEF's January 2025 report said that 41% of employers, they plan workforce reductions due to AI, but simultaneously 77% plan to upskill workers because the AI that would enable those reductions, it doesn't actually work yet. And so the pattern's pretty clear, like 170 million new jobs will be created. 92 million are supposed to be displaced, but the displacements, it's quite theoretical still, and it's based on AI capabilities that just don't exist yet. And so companies expect AI agents to transform everything in 2025. I know it because I've been part of like 10 or 11 AI transformations now, and it's working. But the problem is that as builders, we're admitting that the technology isn't completely ready for prime time yet, which doesn't mean it can't automate mundane tasks or do some really impressive stuff. But it's a subsidized model and some of the tech just isn't ready yet. Now, when this bubble pops, the idea is that it's not going to be gradual. Probably what will happen is like one of these major AI companies will probably miss earnings really badly, probably Q3, Q4, 2025. And then when the 40 billion funding runs low, the stock will probably crater overnight. And then you're going to see contagion. So it's going to spread through the entire AI supply chain, from model makers to cloud providers to like chip manufacturers. That's usually what happens. We've seen this movie play out before, the .com crash, the crypto winter, and then the pattern's always the same. You see massive investment, limited real use cases, sudden realization, and then your Gartner hype cycle bubble sort of bursts, and then we start building up gradually again. But here's what everyone's kind of missing, I believe, and here's why this matters beyond stock prices. I think the technology is still definitely sort of revolutionary, especially, we build a lot, and I think the tech and the tooling behind it is absolutely revolutionary. Think about it. Even with today's flawed AI, we can already generate first drafts 10x faster. We can analyze patterns, humans would never spot. You can already automate repetitive, mundane tasks, create personalized learning at scale. The bubble is going to burst because we're overpaying for the wrong vision, essentially. And when it does burst, something important is going to remain. It's the infrastructure for the next computing platform. So every transformation that technology goes through looks like this. The internet bubble burst in 2000, but broadband infrastructure was there. And that's what was beautiful. Mobile app mania. Remember that one? It cooled, but the smartphone, they transformed society for better or for worse. So my conclusion is kind of like the bubble's going to burst from a company valuation point of view. A lot of companies are going to fail. I think valuations will crash, but the infrastructure is going to remain. And that's what's beautiful. The knowledge is going to compound. The communities are going to stay there. The builders are going to keep building. In 12 months, you could be reading about the crash, wondering what happened to the 300 billion valuations, or you could, be using the tools, understanding the real capabilities, position for what comes next. And that's how I'm positioning myself, at least. The tourists will leave by that time. And then the builders, we're going to inherit like better tools at lower prices. So the crash isn't the end of the So the crash isn't the end of the AI story. It's the end of chapter one, I would say. The bubble's probably coming. Your opportunity, as usual, is right here, right now. And then understand the tech, play around with it, build, ignore the hype, and kind of keep building for the real world. That's how I'm positioning myself, at least. And I hope this helps a little bit.